Hi, Jim Gore from THOR Investment Management. What I want to talk to you today is about risk, how you measure it, and how you manage your portfolio towards risk. Now, my earliest experience with the risk was watching my childhood hero, Evel Knievel. When he would jump his motorcycle over 100 cars, he will either end up being a hero or he'd end up with 20 or 30 broken bones. What you don't want to do for your portfolio is end up like Evel Knievel, where you're either a hero or you end up where your portfolio is broken. The one way to measure the risk in your portfolio is a term called beta. Beta is basically your correlation versus the market. So the market is always one. Your portfolio's beta, if it's 40% more risky than the market, would have a beta of 1.4. If it's 40% less risky or less volatile, it would have a beta of 0.6. So what I want to show you is a hypothetical example of these two portfolios over a 5-year time period. If you notice, terms of the low beta portfolio is actually less volatile than the market, where the high beta is more volatile. 2 years I want to point out is year 3, when the market did exceptionally well. The high beta portfolio would end up outperforming the market significantly. However, in year 4, you would see the exact opposite. When the market was down, the high beta portfolio underperformed significantly, where the low beta portfolio did not. We believe that this is a time, just like 2000 and the year 2000, that you want to manage your portfolio for lower volatility, lower risk. However, it was different in 2008, 2009. We were actually adding risk to the portfolio and adding a higher volatility. So how do we lower your risk in your portfolio? There's 3 things that we are actively doing in the portfolios. One is we have a lower equity exposure than our clients' targets. So someone that has a target of 75% in equities, we are about 50 to 55% in equities. Second is we've added things to their portfolio that are uncorrelated with the market. Basically, these are investments that will move completely different than the market. And in some cases, when the market is down, they're actually up. So we're actually having something that might actually make money in a down market if there is one. And third, inside the equity positions, we're buying things that are cheaper than the rest of the market. And why is that important? Because we believe they have more upside potential than downside risk. Good example of that is energy, where they're the only sector in the S&P 500 that are selling below book value, their median book value, for the last 20 some odd years, where every other sector is well above their average for the last 25 years. So in conclusion, if you are taking risk in your portfolio, you should measure it by beta, and if you're taking too much risk, now is a good time to reduce that risk and put some other things in your portfolio that will make money in any market.